Good morning, everyone, and thank you for joining us today for the latest in CBM's ongoing webinar series. Today's session is entitled Grow Your Net Worth, Top Strategies and Opportunities for Mid-Career Professionals, and our presenters today are Alex Seleznev and Jordan Egert. Alex is a partner, senior advisor, and portfolio strategist at CBM and MBI, the firm's financial advisory subsidiary. He is a certified financial planner and a chartered financial analyst who leads the firm's investment management division. Alex's professional focus is on comprehensive financial planning and investment management. He is a regular presenter for CBM, and in addition to today's session, he's scheduled to co-present in an October 21st webinar, tentatively entitled A Sensible Approach to Long-Term Care Planning, and on November 2nd in a session entitled Grow Your Net Worth, Top Strategies for Retirement and Post-Career Planning. He was quoted in April in a Kiplinger's article about searching for yields in a low-yield market. Jordan Egert is a senior manager with CBM with nearly 15 years of experience in financial analysis, personal and closely held business tax matters, financial consulting for collaborative, mediated, and litigated divorce cases, and forensic accounting. His work has involved accounting and financial planning and analysis for support and property division matters in divorce, including cash flows, lifestyle and budget preparation, and examination, retirement projections, tax projections, and asset and liability division, including their tax ramifications. Jordan has also been a regular presenter in CBM's financial planning presentation series, and he's scheduled to co-present with Alex on November 2nd's Grow Your Net Worth session. This session is being recorded. If you have any questions at all during the webinar, please use the chat box and our presenters will respond to them as they are able. Presentation slides will be sent to attendees after today's webinar. If you're participating using your phone, please email me your name and phone number so I know who you are and can send you the slides. My contact information should have been on the registration confirmation email that you received. Something that's a little new for today's session is that we are offering continuing professional education credit. What that means is that we'll be launching a series of 4 polls over the next hour so that if you respond to at least 3 of the 4, you will receive credit. If you're not sure what CPE is or if you're not interested in participating, that's perfectly fine. You can just ignore the polls. I'm going to take a second now to launch a poll so you can see what it looks like as a sample. Let's see. And there it is. The poll will appear in the meeting screen and in the chat box. You only need to respond in one location. And then for those of you who do respond to the polls and are interested in CPE, you'll receive a certificate after the session. And now I'm going to turn it over to Alex and Jordan. Thanks once more for joining us.
All right, thank you, Joe. Appreciate the great introduction. So as Joe said, there's some CPE available, so just keep your eyes open for this poll. So it'll pop up randomly throughout the presentation. So the reason we're here today is threefold. Really, we have a couple learning objectives that we're walking through. One is that we want you to understand some key methods that you can use to grow your net worth, to increase your assets and your inflows and decrease your outflows. We'll be doing that by talking about retirement planning, some strategies for investments, considering liquidity, considering budget concerns, and then talking about, at the end of the presentation, some tax-efficient methodologies that you can use or consider when you're going through your net worth analysis and reviewing it. So 5 topics today. Alex will talk about financial independence, some investment ideas. I'll be talking about cash flow ideas and some liquidity considerations, such as where to park cash, how to access cash. And then we'll wrap everything up with some College 529 savings plans discussions and some tax discussions as far as what's on the horizon, what's happening today, and how you can best position yourselves to decrease the amount that you're paying to the taxing authorities. So with that, I'll turn it over to Alex.
Alex, you're muted, I believe.
My apologies, I muted myself. So again, thanks everyone for joining us today. So I'll tell you that the very first time Jordan and I gave this presentation was actually in person. It was more than 3 years ago at this point. And I remember at the time when we were preparing to do it for the second time, it's like, well, what's the purpose? Why are we doing this? Well, of course, to educate our clients. That's one of the most important ideas here. But then I remember coming home and my older son, he was watching the cartoon version of Alice in Wonderland, which is, of course, classic. And I remember there was this exchange between the Cheshire Cat and Alice when she goes down the rabbit hole. So eventually she meets the cat and then she asks, "Would you tell me, please, which way I should go from here?" And then the cat responds, "Well, that depends a good deal on where you would want to get to." And Alice says, "Well, I don't much care where." And the Cheshire Cat responds, "Well, then it doesn't matter much which way you go." And then Alice responds, "Well, as long as I get somewhere, right?" And then finally the cat says, "Oh, you're sure to do that if you only walk long enough." And interesting, that really stuck in my head. That is where our clients, at least those who reach out to us for the first time, find themselves. They already have something in place, and this is designed for mid-career professionals. They're already working, perhaps they already have some savings in place. They're already saving some, they have multiple types of accounts, but there's no cohesive plan. So they're going somewhere, but there's no actual direction in place. So that is something that we want to solve today. Next slide, please. So we'll start with the idea of financial independence and investments. And here, by the way, in terms of this whole idea of financial independence, that really depends on your personal preferences. The classic idea is that you retire comfortably, and you prepare for that. Of course, over the past decade or so, the idea of retiring early became very popular. Perhaps you've heard of the FIRE movement, when people save with the goal of not working when they're in their late 30s, early 40s, or sometimes even younger than that. For some people, it's the idea of, I actually enjoy doing what I do and I'm planning on doing it for a long time, but I want to have that option of not doing it if I ever change my mind. So it's really up to you in terms of what that means. Next slide, please. So one of the first questions we would ask, are you on track to achieve those goals, your goals and objectives? There are multiple ways of doing it, and we'll start with some of the easier rules of thumb, so to speak. And what you're looking at on this slide is actually a survey, an internal research that was performed by Fidelity. They analyzed their internal accounts or internal clients, and they essentially determined that if you're 30 years old or in your early 30s, you need to have essentially 1 times your gross salary to be on track for comfortable retirement. If you're 40 years old, it's 3 times your gross salary. If you're 50 years old, it's 6 times. So, if you're earning 100,000 and you're 50 years old, you presumably need to have close to 600,000 in your investment accounts, and 10 times, again, your gross income at age 67. So again, with my $100,000 example, it would be essentially 1 million. Now, this is, of course, a very quick and dirty way of doing it. I'm sure all of you can do this calculation really quickly. This doesn't take into account your personal circumstances, of course. And I'll tell you, for many people, this is simply not appropriate, especially for attorneys. We work with a lot of attorneys because they tend to earn the most in the later years of their careers. So an approach like this would not necessarily make the most sense for them. You can look at it from the perspective of your annual savings. So, there's a minimum probability of success. If I said it correctly, if you're saving only 5% of your gross income. And I happen to agree with the outcome of this particular piece, because usually would recommend more than that. 10 to 20% of your gross is the sweet spot, or preferred. That's when you have a good probability of success, and of course of those who are trying to achieve their goals faster, and perhaps they have the ability to do so. 25% or more, again, of your gross income provide even higher chances of success, and we'll come back to this a little later. Next slide, please. So at this, Here's, I guess I'll keep going. So at this stage in life, this is one of the questions for mid-career professionals specifically. One of the questions we tend to ask, maybe not necessarily this directly, but this is where we would go with our essentially initial interviews. What is your number? What is it that you're trying to accomplish? How can you quantify, what amount of money in this case would help you accomplish your goals? So if you look on the middle example here, let's say that you've determined that you would like to maintain a lifestyle of $10,000 per month. Let's just assume that's the case. Well, if you're 35 years old, if you're planning on essentially pulling funds out of your accounts at age 65 and you have a long life expectancy, meaning to age 95, you would need to have 1.7 million by that point. So again, over the next 30 years, you would need to save $1.7 million. If you convert it into how much you would need to save monthly, assuming that your rate of return is 8%, which is say a little more on the conservative side, that happens to be $1,100. And by the way, in this particular set of examples, we're assuming that in retirement, it would be 6%. Your rate of return would be 6%. Now, why is this important? And by the way, many people, perhaps most of you, can relatively easily do this calculation. There are lots of tools on the internet, of course, we can help you with this, because it guides you somewhere. Meaning, if you're currently saving, let's say, $500 per month and you need 11, well, that tells you something. It means that you need to save more. Sometimes it's actually the opposite, which is rare, but every so often people actually save too much, and as a result of that, their existing lifestyle perhaps suffers, but that is relatively rare. But again, the idea here is to create a guide in terms of where you're going. Next slide, please. So this is one of those things we keep talking about it, and I tend to emphasize it, the power of compounded interest. So here we have Ben and Arthur, and both of them are savers. Both of them, younger. Ben decided to save $2,000 per month or per year. I'm sorry, when he turned 19 years old. That said, not that many people or 19 years old can save 2,000, but Ben managed to do that, and he saved that much over the next 8 years. So his total savings is essentially $16,000. Now Arthur, was not able to save $2,000 all the way to his age 27, but then he continued with the same level of savings all the way to age 65. So the results for both of them are actually quite astonishing. So Arthur ended up, as you can see, with $1.5 million in his account. For Ben, it's even better. It's almost $2.3 million. And again, if you go back, originally he only saved $16,000. Again, I've seen dozens of calculations like that, perhaps even hundreds, and they're always astonish me in terms of, again, the power of compounded interest. Next slide, please. So what you're looking at here, think of this particular slide as a checklist, and this is how we would frequently approach situations when we already established what your goals and objectives are, and how do we get there. So step one, again, is to ensure that your assumptions are realistic. And here's a good example of what I mean. Again, let's say we have a new client, he or she comes in for an initial meeting. I would normally ask, what are your current savings? How are you doing that? And the answer would be along the lines of, well, my employer matches 3% of my salary, of my contributions. So as a result of that, I'm also contributing 3%. So it's a combination between the two of them is 6%. Well, how long have you been doing that? Well, I've been doing that for the past 10 years, let's say. Well, is that appropriate? Will that accomplish your goals? Should you be increasing your contributions over time? So again, are you working with the realistic assumptions in terms of your savings and other goals? Now, once you determine what those are, usually the best place to start is to at least try to maximize your 401k, 403b, or any other employer-sponsored plan accounts. In year 2021 and this year, it's $19,500, which is, I understand, it's a significant amount. And if you're able to hit that amount, interesting enough, I'll say in practice, for many people, it's going to be again in that sweet spot of between 10 to 20% of their gross income. And of course, if you're married, you would multiply it by 2, right? If you're married and it's each of you is making $100,000 per year, well, 10 to 20% would be somewhere between $20,000 to $40,000 a year. In addition to that, anytime you contribute into your 401k, assuming it's a traditional 401k, you're doing it on a pre-tax basis. So when you contribute $10,000, it actually would not feel like $10,000. It would feel like $7,000 because there are tax savings when you're making pre-tax contributions, and that's important. Similar concept, if you have any excess or additional income in place and you're trying to, again, catch up, is to maximize your IRA contributions. Very similar concept here. Now, the idea of paying yourself first. Perhaps many of you, heard this term, but we actually use it in practice. And here's what I mean. Traditional approach is to say, okay, I have this much in income, this is my tax liability, this is my budget, and whatever is left, I'll consider saving for the future, for my goals and objectives, for retirement, for anything else. Well, how about you do it the opposite way? You figure out what your income is, then you determine how much should be saved. You save that first in the beginning of the month, in the beginning of your pay period or in any other frequency. Then, of course, there are taxes to pay, and then you spend the rest. Understanding that, again, you would need to really change how you think about everything conceptually, but that is one of the best ways, again, to accomplish your goals. Making sure that you're investing for growth, and I will talk about that separately because the whole idea of investing for growth means different things for different people. So we'll talk about that separately. And then, of course, reducing your expenses, right? If you're looking at your income, you're looking at your expenses, you're looking at your taxes, and you don't feel like you have enough to, again, maximize your contributions, well, that's when you'll start thinking about that. Notice here, it's closer to the bottom of the list. At least the way we would approach, the planning process, we would not talk about reducing someone's expenses first. We need to understand everything else before we make that suggestion. The idea of downsizing or perhaps moving out of state or out of your area, of course, one of the hottest discussion points over the past, well, several months at this point. Year and a half, actually. So that's a consideration. And then finally, once you look at all of those different scenarios, and let's just say under any of those scenarios, you're not really able to accomplish your goals, well, the idea that you really need to increase your income, potentially, get a second job if that's an option for you, or potentially even change your employer, well, that's also on the table. But again, that's closer to the bottom of the list. Next slide, please. All right, so investments, or the idea of having a growth-oriented investment strategy. I will say up front, of course, as part of this webinar, we will not be providing any kind of investment advice. These are our general observations, right? And everyone's individual situation will, of course, be different. So again, in the context of mid-career professionals, usually that's when you would want to invest for growth. Your portfolio is not likely, or I should say, there's not likely a need for your portfolio to generate that much income. Now, at this stage, in the game, so to speak, it is very important that you have a good understanding of your overall asset allocation. To put it simply, the split between your stocks and bonds. So let's say I have 80% in stocks and I have 20% in bonds, because that's really what drives your rates of return in the long run. Even better, if you understand different equity styles, and I understand that's a technical term, so you can actually understand how the stock portion of your portfolio is invested, and we'll talk about that separately on a different slide. Now, how do you accomplish this goal? How to invest for growth? You have lots and lots of options. You can use mutual funds, you can use index-based funds, low cost funds, you can use exchange-traded funds, you can even do it with individual stocks. And this leads me to one of the points I wanted to make. Unless the clients that we're working with are in finance, or perhaps they're interested in learning more about investing, we would normally not recommend that they invest in individual stocks. And here's why. I understand this is anecdotal, but this is how it normally works. They hear of a particular stock or set of stocks. Usually those are the hottest issues. they would buy those stocks. And what happens frequently, I understand this is very subjective, those stocks will begin to go up. All of a sudden, you get this confidence that you made the right decision, even though there was no particular analysis performed to actually buy those stocks. Now, next thing you know, those stocks are not hot anymore. 6 months later, 12 months later, the prices of those stocks begin to go down, and you don't know what to do with them. Why you don't know what to do with them? Because you're not sure why you bought into those stocks to begin with, just because your friend told you to buy them, or perhaps you read in the newspaper. Now, the issue with that is not that perhaps you would lose money on those purchases, is that you're not participating in the market advancing, usually upward, again, in the long run. So again, unless you specifically have interest in doing that, I would rarely recommend that you invest in individual stocks. Target date funds. Lots of potential issues with target date funds. Nothing wrong with how those funds operate. They operate, most of them at least, exactly how they're supposed to, meaning over time, they would gradually rebalance your allocation inside of the fund toward a more conservative mix. Now, my first question would be, does that really reflect your preferences over time? So let's say you're in your late 40s, early 50s, a typical target date fund for your age would have a very significant percentage in bonds. Perhaps, as some of you know, bonds are currently not earning all that much. Is that appropriate for you at the time? Perhaps you should change it to something else, and many people forget. So next thing you know, you're looking at someone's investments, that person is not planning on retiring for the next 10, 15, 20 years, but a good quarter, perhaps even a third of that person's portfolio isn't something that is really not earning that much. So what's the alternative here? Again, most 401k plans would have options or static options for you to choose from. Usually it's not very complex to do. And again, if you're willing to spend, let's say, an hour each year to do that, that would be my recommendation. The idea of rebalancing at least annually is very powerful. There was this great piece of research by Vanguard several years ago at this point. Essentially, they analyzed different portfolios, more aggressive, less aggressive, conservative, and they assumed that you essentially never rebalance them, or you rebalance them annually. And essentially, they determined that you can increase your performance results by up to 1% by, again, simply rebalancing back to the targets on an annual basis. And what is rebalancing? That is simply a systematic way of selling high and buying low, which is essentially what most people are trying to accomplish. And then finally, on this slide, again, back to the idea of understanding how your stocks or how your equities are invested. There's a big difference between the performance of growth and, let's say, other types of stocks, such as value stocks, in the long run. Next slide, please. So this is, again, what I was referring to earlier, so you can see it visually. So the allocation on the right, the balanced allocation, in some sense, as the name implies, it has an approximately equal percentage in different categories, meaning value, blend, and growth. The one on the left certainly overweight, how we say it, in growth-oriented investments, specifically in large cap stocks in this case. This is not meant to say that one is better than the other, but the point I'm trying to make is that they will likely perform very differently in the long run, and perhaps based on your personal investment goals and based on your risk tolerance, you would actually prefer one over the other. Next slide, please. Then finally, in terms of your asset location or the overall tax efficiency of your portfolio, this is a great time to start thinking about that, again, in the context of our presentation today for mid-career professionals. The assumption I'm making here is that you have two types of accounts. It doesn't really matter how much you have in each type of account: tax deferred and taxable accounts. In your taxable accounts, we would prefer that you keep your reserves. That's where you keep your reserves, and so-called buffer-like investments. You're talking about money market accounts, certificates of deposit, short-term bonds. Perfectly understanding those are not yielding all that much at this point, but normally this is where you'd want to keep those. Passive or index funds and ETFs, they're also a great choice. They tend to be very tax efficient, at least most of them, and also mid and small cap domestic stocks. In general, they do not pay that much in dividends, so they tend to be tax efficient. And of course, the opposite is true for your tax deferred accounts. That's where you would prefer to keep investments that generate a lot of, let's say, current income, or perhaps make large capital gain distributions, such as income-oriented investments, such as real estate investment trusts, or actively managed strategies such as emerging markets. And finally, with large cap stocks, especially certain categories, you do want to keep them in your tax deferred accounts because they make significant dividends. The point is, if you don't necessarily memorize anything of what I just said, is that when you have two types of accounts, consider investing differently in each type of account. With that, Jordan, what else do you have for us?
All right, thanks, Alex. That was definitely a great segue into our next topic about cash flows and budgeting. I'm not going to go too far in depth on what it means to manage your cash on a daily basis, but what we will talk about is just some tools that you should be looking at or considering when you're trying to either increase your inflow or decrease your outflow. And that's effectively the formula that we use to build net worth. If you can keep more on the table for yourself, not only are you keeping more in your pocket, but you're also increasing the aptitude of growing that money into the future. So the easy way to do it is make more money. That's always the quick and dirty. But the even simpler way to keep more on the table is to really get a good understanding of what your liabilities and expenses are. Many of us, and I'm somewhat guilty of this from many years ago, just kind of look at the bottom line. And as Alex said, we see that we have enough at the end of the day and go, okay, that's great. There's enough to, have a nice dinner on a Friday night, get my new car every 2 or 3, 4 years, etc. So why do I need to care about my budget? A lot of what we experience as we go on in our career is called lifestyle creep. So as our income starts increasing, so do our expenses. And before you know it, that 20 or 30% increase in our wages over 5 or 10 years is eaten up by the expenses and additional lifestyle that's keeping up with it. So I like to put out there that several times a year we sit down and we really go through our budget and our expenses. And it might not be something where we're looking at, a Starbucks run once a week or something to that extent, but we really want to consider and see if there's any sort of consolidation of our expenses or some way to reduce at least the larger expenses. And some of the items that I generally look at and Alex looks at when we're discussing, some sort of plan or goals with our clients are really taking a stab and reviewing the big items: mortgages, student loans, health insurances, and to a lesser extent, food, entertainment is also a huge component. So we sit down and work through all those items with our clients or with other individuals. And so just a few items I wanted to point out when we're looking at, how do we reduce some of this bottom line, or how do we reduce some of these numbers to increase our bottom line? We'll talk about mortgages in a second. But one of the items we used to talk about, we just ran out of time in prior presentations, was a concept of being under or over insured. And that's one of the budget items that we find many of our clients just kind of tick the box and find out that their $1,500 a month health insurance policy really isn't providing $1,500 of benefit. And I'll give you a great example. I had a client several months ago come to us, pretty good salary, $150,000 a year, was able to keep up with their mortgage, put some in savings, but still felt like there was not enough. And so we quickly identified that they were overinsured. And by looking at their health insurance policies and reviewing what was actually applicable to them, it made more sense to downgrade to a lower cost health insurance policy. And they ended up saving $1,000 a month just by matching up their needs with how much with their needs for what they were actually utilizing. So that's one of those low-hanging fruit items that we can look at to decrease expenses almost immediately. Okay, and there is an item on here. We're talking about liquidity in a minute, so we'll go into that in a few slides. But I also want to talk about, the options of identifying these items first. Go through your budget, identify them, and really see what you can consolidate or what you can curtail. So basically how you can play around with all the items and either reduce the amount of interest on any debt covenants you might have, such as consumer debt, refinancing, student loans, etc. There's tons of options available right now where you can even just go online, punch in student loan reduction, if those still exist, or if you're paying or assisting your child with those. Tons of programs available. So the internet's pretty powerful right now. Take some time and just take a peek and see what's available out there. Tons of tools. I will put a precursor out there that every single sort of consolidation tool or any single sort or item that falls in the borrowing camp has its own rules, restrictions, regulations that come with it. And so just make sure that if you're looking to consolidate anything or you're looking to reduce down the debt or reduce down the expenses, that you understand the terms of what happens. So by way of example, let's say you have a consumer debt that has a $50,000 balance on it at 10%, and your only asset available is your retirement account. You might be able to borrow from that account to pay off that asset, but you would need to also know that if you don't repay that loan to your retirement account, there are stiff there's stiff penalties, taxes involved, etc. So we normally don't recommend that to curtail some of your expenses, but that's just an explanation or an illustration of some of those items that you need to review before you pull the trigger on reducing expenses or reconsolidating. So we talked about mortgages for a second. This has been one of those very hot topic items this past year, I'd say almost 2 years, especially given the environment of how rates are kind of shaking out and how the Treasury's playing around with the bond market. So one of the things that we can do is, at least right now, is look into refinancing, and that would cover one of the largest expenses on our budget items that we might have going forward. And a lot of individuals have asked, hey, I know maybe I'm saving $100 a month. Is it worth it? It's going to cost me to do this. I don't know if it's worth it then. I'm only staying 5 or 6 years. Is it worth it? So I have some rules of thumb, and then I'll show you how the numbers kind of shake out in this analysis so you can see why it's an extremely powerful tool. The general rule of thumb, and every situation is different, is that a refinance makes sense to reduce down your cash outflow if you're staying in your house longer than 5 years, if you're having more than 1% decrease in your rates, and if there's minimal cost to do the refinance. Those are just general rules of thumbs. However, recently, the terms have kind of flipped around a little bit, and now the consumer holds the power to look into refinancing. So now we see no cost refinances. We see rates that are far in excess of 1% decrease of where most individuals or taxpayers are at. And we also see that the 5-year rule no longer matters. And I'll show you why in a second here. So I'll give you an example. This is an actual example of one of our clients we worked with recently, where they have an $800,000 original principal on their house, and they paid it down to $625,000. I think that was over about 8 or 9 years. So what's left is that $625,000 balance, and they have a $4,000 principal and interest payment every month. So what we looked at, because they were a little nervous to refinance, they were getting quotes of $20,000 in fees to refinance. We ended up identifying a product that was available for a 30-year fixed mortgage that basically strung out the payments another 30 years, but ended up freeing up $1,500 in cash. So basically their payment went from $4,000 down to $2,500 and some change. So to me, kind of a home run here, because now you have an additional $1,500 that you can put in the market or invest or use otherwise for other items instead of, getting a 2.75% return. I actually did the math on that, on what happens if you were to invest that $1,500 per month over this 230 months. And if you were to do that, you're effectively coming out with $1.5 million in excess of where you would be otherwise. So I am such a huge proponent of refinancing if you have the ability. Some of you are probably asking, well, what happens if I move out in, I don't know, 5 years? Not really that big a deal. You can always take the position that you continue planning to pay the same amount. And so what happens if you pay the same amount instead of investing elsewhere is that instead of over the life of the mortgage paying $310,000 in interest, your interest immensely and materially decreases over the life of the loan to $147,000. So you're saving $160,000 over the life of the loan. And the kicker is you're paying it off 40 months faster, so 3.5 years faster, all for doing the same thing you were doing anyways. So I'll leave you, because I know many people are calling and asking over the past couple of months what general rates are. Just know a good rate right about now on a jumbo mortgage is about 2 3/4 for a 30-year. A 15-year is kind of hovering about 2 1/8%, and all of these should be refinancing available at no cost to you. And if you have questions on how that kind of pans out, please feel free to email Alex or I, and we can work through it with you. So here's just a chart that shows you how everything catches up. It's just a good summary of what we were discussing earlier. You'll see that on a minimum payment on a refinance, the principal is getting paid down basically much quicker than a prepayment on the current loan item. So just something to keep and look at if you have some time after. So liquidity, we discussed that very briefly earlier. Alex also discussed that in his financial independence savings investment strategy of having a buffer. And why do we care about having a buffer? Well, having a buffer, or liquidity in another term, really affords us the opportunity to avoid the risk of any loss of an asset that's invested when we need or want cash or a cash-like instrument. So what does this mean in practice? This means that we have some sort of plan in place that says if I have, for example, an emergency medical bill of $25,000 that needs to get paid, I have a way to pay that without pulling out of something else that may have a loss in value. So a good example is, $100,000 is in the market, and then all of a sudden we have a 50% dip, God forbid, in the market, and now you have a $50,000 asset. So if you have nothing else in place to cover that cash need over here, you are now pulling off of that 50% decrease to cover that cash need. So we bring this point up not because we have a steadfast plan to provide to you of what you should be doing, but just to bring it up for consideration purposes. We normally talk to our clients or we talk to individuals and we ask them, what happens if you have a $5,000 emergency expense? What happens if a $10,000, $50,000, $100,000? And we just kind of get those things kicking in the back of the mind. And so when we talk about liquidity, it's not always that we need cash. Cash is great. It gives you easy access and it's generally always there. But there's also other options you can consider for maintaining liquidity. I always like to consider, having a home equity line of credit or a line of credit that you have access to. In doing so, you basically have no responsibility or liability until you pull off that line and you need it. It's a very cheap way to borrow, and it doesn't start the clock until you pull or draw on that. So really nice way to have kind of a backup if you only have X amount in cash, and then you have a home equity line or a line of credit to back that up. Some alternative ways if you're trying to get creative too. Don't normally suggest this, but it's always there if you're a little bit more sophisticated, is you can start looking at doing credit card advances or 0% balance transfers, etc. It's just a nice emergency way to build up liquidity and cash reserves should you need them. So just have a plan and make sure you kind of review it annually to make sure you have all those costs covered in case they happen. Okay. So 529 planning, I will try to get through this as quick as I can. We actually have several seminars on this a year, and they take up well over an hour. So I'm going to give you the highlights, some little tidbits and information that'll kind of help put you on the right path here. So we always talk about savings for college, not only for our kids, but also for ourselves. We want to make sure that we're supercharging our net worth as much as possible, and we're not left holding the bag 18 years from now as cost of education continue to increase. And this chart's a little bit old from 2018, but what's interesting to me is that we're seeing increased student loans over time, which isn't surprising as as the cost of education goes up, but it also paints a different picture as well, that not as many individuals are taking advantage of 529 plans or savings for college as they should. And at face value, savings seems pretty, astronomical when you see X dollars. But when you break it down, as we'll talk about in a second, it's really not as over the top and overburdensome as we would think. So the key takeaway here for college savings is, save something. Doesn't matter if it's in a regular account, a not regular account, wherever, just start saving something. The efficient way to do it, however, is to utilize something called a 529 savings plans. And what these 529 plans are effectively a retirement account. Think of like a 401k account where you have a benefit, a tax benefit, and it can come possibly tax-free out at the end of the day. But its sole purpose is for education and education-like expenses. So what happens is you'll put the contribution into the plan, it grows, and then 18 years from now, 20 years from now, 10 years from now, when you're ready to start using it for qualified expenses, you can pull that out and all the growth is tax-free, the distribution is tax-free, and you basically just supercharge your savings. Instead of having $1,000, you might have $5,000. So in the 529 plans, there's two flavors. We'll talk about that in a second. One is generally more preferable than the other. And then there's possible tax deductions as well that are associated with this. So let's walk through an example here just to show you the importance of the 529 plan or college savings in general. So projected forward, there is an estimate of college cost in 2036. Let's say it's 2037. The slide's maybe a year old at this point. Is $164,000. Right? That's a pretty large number. So in order to get to $164,000, if we were to start saving today inside a 529 plan, all we would need to contribute, assuming a pretty conservative 7% return on investment, is $419 a month. If we were to do that, we would cover 100% of the tuition cost in 16 to 18 years when 2036 hits. So compare that, if we hadn't done any sort of 529 savings, we would find ourselves $80,000 under where we need to be in that 16 to 18 year period once 2036 hits. So it's a pretty powerful tool on a savings on its own, but consider this, that you're also not paying tax on any of the gains, any of the dividends, any of the interest while invested inside of that 529 plan. So that $164,000 might be worth $200,000 if you consider the tax ramifications of it. So the power of the 529 plan is awesome. So here's a good example. I obviously can't name a client, but many years ago, we had a client come in and said, hey, I really meant to get behind a 529 Bandcamp. I couldn't get to it. My budget didn't really allow it. I want to start now. And unfortunately, their kid was 18 years old, already going through college. And so we were able to assist them a little bit, but it ended up that their child had to take on student loans. And so what ended up happening, and I'll use this example to explain, is that their child ended up taking over $200,000 in student loans, and the interest is compounded and compounded and compounded. And so if we use this example, what ended up happening that their student loans over a 10-year period ended up having about $1,700 or $1,800 of required monthly payments. So think about burdening not only yourself, but also your child with almost $2,000 a month of payments right as they graduate and start spreading their wings a little bit. So all of this, needless to say, if we're having the horse in front of the cart, we would have $419 a month for, let's say, 16 to 18 years, and not have to burden our child with paying $220,000 of education cost and finance cost over the life of the loan. Pretty powerful, $130,000 difference. So keep that in mind. We're not saying you have to 100% fund your savings plans or savings accounts for college, but any little bit helps to avoid running into this situation. So as we discussed, there's two flavors. There's a 529 savings plans and a prepaid tuition plan. The prepaid tuition plan is really just effectively a prepaid contract where it says, all right, you give us $100 a month for 18 years, we'll guarantee the contract on this specific education. There's all sorts of prohibitions with this that make it not really a great first option. You can transfer the benefits inside of the savings plans, but generally you lose the tuition contract benefit. So you lose all that benefit of 18 years of savings. You only can use it on tuition costs generally, might have age restrictions, etc. So we normally keep this to the side unless someone's really gung-ho on opting into a prepaid tuition program. The savings plan, however, acts more of like, let's say, a brokerage account, except it's earmarked for education. So you have ability to direct your investments. So if you want to be extra aggressive and shoot for 10% a year on return, or less aggressive, maybe go for 2 or 3% a year, you can set your account up to do that. There's multiple investment options. There's options to transfer the assets between siblings, between family members, etc. And there's no age restrictions on a plan. It's a pretty sweet deal, and the limit across different states is generally $500,000 per beneficiary in their 529 accounts. So we normally don't see anyone hitting that, but just know it exists. So if you have someone or a child that wants to go to Harvard and then do grad school at Yale and then get a doctorate over at Stanford, maybe you'll hit that. But that's another discussion to be had. So what do we consider for contributions and deductions? Here's just a couple takeaways. These aren't hard and steadfast, but just know that these are up to the amounts that are deductible for taxes. So if you were able to contribute $2,500 yourself to your child, $2,500 in Maryland would be taxable for a state-sponsored plan. It must be a Maryland-sponsored plan, must be a DC-sponsored plan if you're a DC resident, and so forth and so on. And so the interesting thing here is that you can contribute $2,500, and generally your spouse can contribute $2,500. So you've now put $5,000 in for the year and had that deduction. So something to note, they all have carry forward provisions. So what that means is if you front load some of the contributions into the 529 plan and you go over the $2,500 limit, it'll just carry forward until you're able to deduct it on your taxes. So, we might tell someone in year one, if they're in Maryland, might make sense to contribute $25,000 now. And that way, over 10 years, you're not losing a tax deduction for the contribution. So there's other ways to get even more cash into it on the front end, but it's really a case-by-case basis.
Excuse me, Jordan, I just wanted to intervene for a quick second to let you and Alex know there's about 10 minutes left in the hour. So if there's any questions you wanted to entertain from the attendees, now might be a good time to, to ask if anyone has anything they want to ask.
Sure. So thank you, Joe. So we'll talk about taxes just for a few minutes. I'll keep it pretty high level. I just want everyone to make sure they have an idea of what's going on. We have a few questions we received previously, so we'll discuss those in a few minutes. If you do have additional questions, please feel free to use the chat feature, and we'll come back to them at the end of the seminar. All right, so taxes. This is my favorite part of the presentation. Probably not Alex's, but definitely mine.
Fair enough.
Why do we care about taxes? Again, it's a very simple equation. Keep assets on a table, keep increasing inflows, decrease outflows. And one of the easiest or one of the most interesting ways to do that is really figuring out where you can save on taxes. So what we're going to talk about right now is a House and Ways means tax proposal that hasn't been passed yet, but will have lasting impressions on most, if not all, taxpayers and things you need to consider, and just some general tax planning ideas for this year and possibly next year. So high level, we just saw the House Ways and Means Committee throw together a tax proposal, and I just want to put this out there. Basically, the high level is that if you're an income taxpayer with over $400,000 of income, it seems pretty high, but we're in the DC metro area, and if you have multiple income streams and two spouses with high earning capacity, you might hit that. Basically, everything will disfavor you. The marginal tax rates are increasing 3%, and the rates or the amount of income that's being taxed, instead of the maximum tax rate starting at $600,000, the maximum tax rate is starting at $400,000. So you're getting taxed on more starting at a lower income level. Capital gains are starting to change as far as the tax rate goes. The maximum rate is being proposed to go from 20 to 25%. There's 401k and retirement changes coming. If you're making over $400,000, it's possible that you will no longer be able to make a non-deductible IRA contribution. After tax 401k contributions, which is the opposite of what Alex was talking about earlier, a deductible 401k contribution, which is your standard contribution, is basically being squashed. So that may no longer be a deal. And also Roth conversions, a little above where we need to be in this conversation, but likely dead after this year too. Also know, just real quick, inherited assets are safe for now. That was one of the big issues that the Biden administration was putting forward, where if you inherited $1 million house and your father or your mother had purchased it for $50,000 40 years ago, you would get the step up in basis, meaning that once you were to sell that property, your gains would be based on $1 million. The proposal at some point was saying, no, we're going to base your gain on that $50,000 amount. So for right now, we're safe. So that's really nice. So you can kind of keep that in your back pocket as far as tax planning goes for now. All right, electric vehicles, stuff like that, the credits are going up. The gifting limit, this is important to know in conjunction with 529 planning, has decreased. So your lifetime gifting limit has now gone down from 10 million, which is a pretty big number, down to 5 million. And it's possible going forward that may decrease further. So when you're doing 529 contributions, you want to keep in mind how much you're contributing to each beneficiary with that lifetime limit in the back of your head. Okay. And this is just a quick summary, everyone. So there's tons and tons and tons more in the bill. We're happy to share it with you. Again, it's just a proposal, but once it gets passed by House and Senate, I'm sure we'll see something to this extent. So real quick, some tax planning ideas. I write these sheets up almost weekly and leave them on my desk in case someone calls up and says, hey, I have some rogue income, I have some losses this year. what can we do to curtail some income? So many of the options are tax efficient or tax deferred options. I always like reviewing at the end of the year if we've maxed out our HSA, our IRAs, our 529 plans. My favorite thing to do at the end of the year is to contribute to a health savings account and max the thing out. Basically, what ends up happening for that, we can do an immediate contribution, an immediate distribution, and reimburse ourselves from our health savings account for any expenses incurred up to date. So you've now effectively generated an immediate tax deduction. Pretty cool way to grab some extra cash off your tax return. Consider, looking into readjusting, given the new capital gains rates, how your portfolio might be structured. So you might consider reallocating things from a dividend payout or an interest earning investment more towards a capital appreciation investment where you're not recognizing tax burdens and tax liabilities each time you receive income. Okay, so one of the other options, and then we'll jump into some questions that I always like considering towards the end of the year, is looking at capital loss harvesting options. And that basically means that we're looking at any investments that hold a loss, and we'll say, okay, well, we know it's a loss, maybe in a global ETF. We'll realize a loss, take the tax deduction for it, or take the income reduction for it, which decreases taxes, and then just reinvest it in something that's different, but very similar. So you're still invested in that asset, but now you just generated a paper loss. With the propensity of the probability of capital gains rates increasing, it might this year be a good option to consider gain harvesting. So instead of being exposed to a 25% capital gain rate next year, or possibly the year after, you're only exposed to a possible 20% capital gain rate. Lots of ways to skin a cat here. I have tons of great options, so feel free to shoot me a call or an email. Happy to discuss them further. So our last item, here's just a slide on how you might be able to supercharge some of your 529 tax deductions. It gives you a nice layout of who can contribute where and what plan, and how you might get more than $2,500 on a deduction for a 529 plan. So a good reference item. So with that being said, the overall concept of today is that we want everyone to grow their net worth. And in order to do so, have a plan, tend to it, watch it grow, and just make sure to manage it and review it along the way. Keep in mind that it's not all about the money. It's really about how you get there, the destination, but also the journey as well. So, enjoy the ride, but make sure you're managing it, as Alex had discussed earlier. So just some other housekeeping items. We do have some upcoming seminars. They're in our slide deck, October 14th, 21st, November 2nd. Just a little bit about employee benefits, some post and almost post-career planning for financial planning items. And just for your own edification, we also do have a coronavirus and COVID resource center that gives you some resources as far as planning options and just other things to consider in a financial and accounting realm of COVID. So we do have a few questions, Alex. So we'll hop into those. I think we had 3 or 4 of them, and then we'll go into any questions that came up in the chat.
Sounds good. Thank you, Jordan. So feel free to ask your questions through the chat box. I always say this, we will read them out loud, but we'll not mention your name. So it will be private. So feel free to ask any questions you have. All right. So in terms of those that were submitted to us prior to this webinar, here's a simple one. How to invest in stock market? That is the question. There's a short answer. There's of course a much longer answer to it. So I'll say usually the best way is to start with your employer-sponsored plan, such as 401k. There are multiple reasons why it's usually the best option. One of them is because typical 401k plans consist of 10, 15, 20, maybe a little more investment options, and as a result of that, it's hard to necessarily make a bad choice. So that's why. There are also tax benefits, as I mentioned earlier, in terms of contributing to your 401k, and overall, again, it's a very simple way of getting started. Now the question for you, for most likely for Jordan, actually, I'll read a part of it. Definitely curious if you start late aspect of this, planning process. I'm always looking at the pros and cons of the 529 plans. I'd be curious to hear the presenter's take on the idea that you can borrow for college, but you cannot borrow for retirement. So it is better to put all of your money toward retirement and not a 529 plan. Do you agree with this idea?
So I think we can have a bit of an open discussion on this. The real answer is it depends on your situation, of course, and what your financial plan is. But at the end of the day, the best strategy is one that suits your needs. Retirement contributions are always at the forefront, and it's one of the pay yourself first situations. The great thing with retirement is you have a lot more options of how you can play around with it when a time comes to take distributions. 529 plans, you're kind of locked into using it for education purposes. And you might run into a situation where your kid decides to be an artist and decides not to go to school anymore. So what happens then? So it's kind of a give and take. I wouldn't say that one holds precedent over the other. But Alex, I think you probably have some insight as to what you would think as well, given everyone's different financial paralysis.
Well, it's interesting. You can certainly argue in both directions, but usually, yes, we would focus on maximizing your retirement contributions first. And the reason that's the case, there's usually limited real estate, so to speak. There's only but so much you can contribute into your 401k or IRA account each year. With the 529 plans, where they're effectively unlimited, it's $500,000 a year. To combine, I'm sorry. So you can contribute anytime. Now, some people, it's just their personal preference. Their parents paid for their education. They absolutely want to do the same for their children. So, of course, would amend the overall plan based on that. But I would say usually it is better to maximize your retirement accounts first.
Okay. And let me just real quick, I want to piggyback on that since there's a 529 question in chat.
Yes. Please.
Yeah, so we have a question that says, can you pay from new 529 plans after graduating and having student loans to pay? Great question. We had some revisions to the 529 plans due to the CARES Act and all this craziness that went on the last 2 years. As part of that, you can establish a 529 plan and then immediately turn around and pay student loans out of it. But the amount you can do is capped. I believe it's $10,000.
$10,000.
Great. So $10,000 out of that. But that's one of those other nice low-hanging fruit items where if you go, all right, I'm going to make my payments this year, you can just fund $10,000 or $1,000 a month, 866, whatever the math comes out to, and then just immediately turn around and pay off that student loan up to that $10,000 limit. So you're basically creating an immediate tax deduction for doing that, and then also maybe get a little bit of investment return on that as well. So the cart can go in front of the horse in that case.
Well, I agreed. I don't necessarily have much to add to that. Thank you, Jordan. All right, so here's another question from, again, that was submitted to us before the webinar. Real estate holding / paying off your retirement home before retirement. So I believe I understand that question. So one of the common or traditional assumptions is that, and I know we're changing subjects here a little bit, is that you should retire debt-free. To the most part, I happen to agree with that concept. But again, given where we are with interest rates at this point, which is what Jordan talked about earlier, here's a simple comparison. If you have a mortgage and let's say you're about to retire, you have 10 years left. The interest rate that you're paying is, let's make it 3%. Your portfolio is expected to earn 6 to 7%, and let's say it's mostly in tax-deferred accounts, meaning anytime you take the funds out, you'll be paying taxes. In this scenario that I'm describing, why would you want to pay off your mortgage. You're not only paying more taxes, when you take the distributions out, but also there is such a significant difference in projected rates of return. So my short answer is it really depends on your circumstances, but given where we are with interest rates, I would normally suggest that our clients focus on investing versus paying off their mortgages. Jordan,
yeah,
any thoughts on?
Completely agree with you. Again, it depends on the framework of our clients and any of the individuals. Had we had this conversation 2 years ago when rates were 4-5%, 3 years ago, I would say 99% not really worth it. But to piggyback off Alex, the interesting thing right now is, let's say you have a 2.5% mortgage. Where else are you getting a guarantee of paying down at 2.5% return on your money? It's a pretty great deal, and a pretty good deal to get cheap money as well. So I'm on a camp where it depends, like Alex said. Generally, getting the monkey off your back is great, so you don't have to rely, you don't have to worry about paying that burden down. But again, cheap money and cheap borrowing has completely thrown a wrench in that wheel.
That's right. It's already 5:12, so I guess we should probably stop at this point. If any of you have any other questions that we did not cover in our webinar today, feel free to reach out to Jordan or myself. Our contact information is on the slide, and we would be happy to discuss those questions with you. So thank you. Thank you for attending.
Yes, thank you, and we'll see everyone hopefully on Thursday, October 14th, the 21st meeting.
Sounds good. Thank you, everyone.